All right, let's talk about a puzzle that every single business, I don't care if you're a giant tech company or a local car dealership, has to solve. And that is, how in the world do you account for a cost that hasn't even happened yet, but you've got a pretty good feeling it's just around the corner? Well, today, we're going to crack open the official rulebook for that exact problem.
I mean, think about it for a second. Your company could be facing a massive lawsuit. Or maybe a product you sold has a warranty, and you know some of them are going to fail. If you just ignored those potential costs, that feels, well, kind of dishonest, right? But if you book them too early, you could be misleading investors. It's this incredible tightrope walk between being prepared and being factual, and there's a specific accounting standard designed to guide us through it.
So the real heart of the issue is this word right here, uncertainty. We don't know exactly when we'll have to pay or exactly how much it'll be. And that's a huge headache for financial statements, because they're supposed to be this crystal clear snapshot of a company's health. So how do we handle it?
Well, in the world of accounting, the answer has a name. It's called a provision. And all that means is a liability where the timing or the amount is up in the air. Let's make it super simple. You know when your car starts making that weird rattling noise, you just know a repair is coming. That future cost feels real, right? Even before a mechanic ever hands you a bill. In the business world, that feeling has a name, a provision.
Okay, but here is the critical part. You can't just start creating provisions for every little what-if. Imagine if you could. Companies could just build these giant, vague, rainy day funds to stash profits or smooth out their earnings whenever they felt like it. It would be chaos. And that is exactly why we have a very strict, very specific rulebook called International Accounting Standard 37, or as we call it, IAS 37.
So let's get into it. What does this rulebook actually say? At the very heart of IAS 37 is this beautifully simple but incredibly powerful three-part test. This is it. This is the whole game. It's the key that decides whether that fuzzy future cost gets to be on the official financial statements.
And here it is. For a company to book a provision, it has to check all three of these boxes. No exceptions. First, there has to be a present obligation that came from something that already happened, like selling a product that comes with a warranty. Second, it has to be probable that you're going to have to pay out some cash. And probable is a key word here. It means more likely than not just a tiny possibility. And third, you have to be able to make a reliable estimate of how much it's going to cost.
Now listen up, because this is probably the most important part of the whole standard. It is all or nothing. If you can't give a firm yes to all three of those conditions, you cannot, under any circumstances, create a provision, period. This strictness is what prevents companies from creating those misleading slush funds for a rainy day that might never actually arrive.
All right, that's enough theory. Let's get our hands dirty. Let's put this three-part test to work and see how it actually performs in a couple of real-world scenarios, ones you definitely see in the auto finance industry. Let's see if we can figure out the right answer together.
So first up, gap insurance. You've probably heard of this. It covers the gap if a car gets totaled and what the insurance company pays is less than what's still owed on the lease. Now let's say a leasing company sells this protection with every single car. The big question is, should it create a provision for potential payouts on day one for every single lease it writes? What do you think?
And the answer is a hard no. It fails the test, and here's why. Right at the start of the lease, there's no present obligation to pay anything. That obligation only kicks in if a car is actually totaled. And since a total loss is a pretty rare event for any one car, an outflow of cash isn't considered probable for the whole portfolio. So the test fails on all counts. No provision.
Okay, let's try another one. Scenario 2. The company finds out that a car was leased using a stolen identity. The car is gone, the customer is a ghost, and the company is stuck with a big loss. The fraud has already happened, so should they create a provision now?
In this case, yes, absolutely. It's a textbook example of when you should create a provision. Let's run the test. Was there a past event? Yep, the fraud. Does that create a present obligation? You bet. Is an outflow of resources probable? It's pretty much certain at this point. And can they make a reliable estimate of the loss? For sure. Check, check, and check.
But hang on a second. You might be thinking, isn't any time a company loses money on a lease just a credit loss? The risk that someone just won't pay you back? That is an excellent question. And it brings us to a really, really crucial distinction in accounting.
So here's the deal. Not all losses are created equal. They fall into two different buckets with two different rulebooks. Over on the left, you have IAS 37.
That's for operational losses that come from specific events, things like fraud, a lawsuit, or a warranty claim. Then, on the right, you have a completely different standard, IFRS 9. That's for expected credit losses, the everyday risk that a perfectly legitimate customer just might not pay their bills. Knowing which bucket a loss falls into is everything.
So, let's zoom out. Why do we care about all this? Why split hairs between these different rules? Well, because it all comes down to financial honesty. These aren't just nerdy rules for accountants. They fundamentally change how we, as outsiders, can understand the real health and the real risks a company is truly facing. So, to wrap this all up, here are the key things to remember. IAS 37 is all about using careful judgment. It's designed to stop companies from creating these vague, blanket provisions that don't mean anything. It forces them to match an expense to a specific risk they've taken on, to constantly review those estimates, and crucially, to draw that bright line between operational risk and credit risk. And really, at the end of the day, it all comes down to this one line, pulled straight from the standard itself. It's all about the best estimate. Now, that doesn't mean a wild guess. It means a company has to use all the evidence it has, historical data, expert opinions, you name it, to come up with the most realistic, honest number possible. It's a promise to be truthful about an uncertain future.
So the next time you're scanning a balance sheet and you see that line item for provisions, you'll know what's behind it. You'll know it had to pass that tough three-part test. And it leaves you with a question to ponder. When you look at a company's numbers, what hidden uncertainties are they telling you about? And which ones are still hiding in the shadows?